$1.5 trillion. That is the staggering amount currently haunting every Federal Reserve official. This isn't about the national debt, credit card debt, or auto loan bubbles. No, this is a mountain of commercial real estate debt, and it's scheduled to mature in the first quarter of 2026. We're on the edge of the largest destruction of real estate wealth since the Great Depression. Over the last 2 years, this financial disaster has largely been ignored by mainstream media, with hopes that interest rates would fall and the economy would bounce back. They told us that the banking crisis of 2023 was just an isolated event and that a soft landing had been achieved. But the math doesn't care about these optimistic narratives. It's clear that thousands of office towers, shopping malls, and apartment complexes are effectively bankrupt at today's interest rates. These properties were bought with cheap loans when interest rates were near zero, but now those loans are coming due. Developers must refinance at rates 300 to 400% higher than before, while the income from those properties has dropped dramatically due to shifts like remote work. Vacancy rates in major cities have stayed above 20% for the last 3 years, which means property owners are facing a severe cash flow crisis. Expenses are soaring while rental income has plummeted. This is not a future problem. It's happening now. Banks are already starting to send default notices to property owners. The era of extend and pretend, where banks allowed borrowers to mask their true solvency, is over. Regulators are forcing banks to acknowledge the true market value of these properties, and it's far lower than the original loans. We're about to witness the collapse of commercial real estate, and it's not just about buildings and landlords. This is also a crisis for the banks that lent the money. Most of the banks exposed to this problem aren't the big, well-known institutions like JP Chase. The large banks saw this coming and have quietly sold off their exposure. The real risk lies with the smaller regional banks, the ones where you have your savings, where small businesses get their loans. These regional banks hold nearly 70% of all commercial real estate debt in the U.S. Many of them loaded up on these loans during the low-interest years because they offered slightly better returns than government bonds. Now those loans are turning into bad debt, and the bank's capital is being drained. We're facing a crisis similar to the savings and loan debacle of the 1980s. Back then, over 1,000 banks went under because they held long-term loans that lost value when interest rates rose. Today, we have more than 4,000 regional banks, and many are already insolvent. They are essentially zombie banks. They're still open because they haven't yet been forced to admit their losses, but the Q1 2026 maturity wave will make them face reality. When a borrower defaults, the bank often ends up owning a deteriorating property. Banks aren't property managers, and they're forced to sell at huge discounts to get the cash needed to cover their loans. Imagine a scenario where a bank loans $100 million to finance a building, and that building can only be sold for $50 million. The bank eats a $50 million loss. If that loss exceeds the bank's capital reserves, the bank fails and is taken over by the FDIC. The chain reaction begins with one default, and it spreads from there, dragging down more banks and real estate values in its wake. The Federal Reserve knows this, which is why they're scrambling to create new lending facilities, but you can't print your way out of a solvency crisis. If they bail out the banks, they'll spark inflation. If they let them fail, the banking system could collapse, and credit would stop flowing to businesses. This fear is already showing up in the market. Bank stocks have taken a beating, with short sellers targeting regional bank ETFs, expecting more banks to fail. The office sector has become the next subprime mortgage crisis. Older office buildings have seen their values drop by nearly 60% as tenants move out in favor of newer, more modern spaces. This is making the downtown areas of major cities look like ghost towns. Walk through San Francisco, St. Louis, or Baltimore, and you'll see boarded-up storefronts and vacant offices. It's not just office buildings that are suffering. The multifamily sector, too, is in trouble. Developers over-leveraged themselves during the real estate boom of 2021, using floating-rate loans to finance apartment complexes. They assumed they could raise rents indefinitely to cover rising interest payments, but rent growth has stalled. Now, many of these developments are facing foreclosure, creating a crisis for investors who thought real estate was a safe bet. Pension funds, insurance companies, and private equity firms are heavily exposed, and when those investments go sour, it could lead to major liquidity problems. The underlying problem in all of this is the liquidity mismatch. Real estate funds promise daily liquidity, but their assets take years to sell. When investors rush to pull out their money, the fund's managers have no choice but to stop withdrawals. We've seen this happen before, and we're about to see it happen again. The entire system is on the brink, with billions locked up in illiquid real estate assets. If your wealth is tied to real estate, you're standing on shaky ground. The true market value of these properties is far lower than what they're appraised at. Sellers are refusing to accept the lower prices, and buyers aren't willing to pay the inflated prices. This stalemate has frozen the market for nearly 18 months. But the upcoming debt maturities are the event that will force the market to find a price. Forced selling is the only way to discover the true value of these properties. Banks will have no choice but to sell at whatever price they can get, which will further depress the market. We're already seeing keys for cash deals where banks pay borrowers to walk away quietly. But there's not enough cash to go around for everyone. The scale of the $1.5 trillion problem is too big for the government to bail out without significant consequences. If the government steps in to help landlords, the public will revolt. If they let them fail, the banking system grinds to a halt, triggering a credit crunch that impacts the real economy. Small businesses will find it impossible to get loans, and they'll start cutting jobs to survive. This is how a financial crisis on Wall Street turns into a recession on Main Street. Credit standards are tightening, and banks are hoarding cash, preparing for the storm they know is coming. Loan loss provisions at regional banks have spiked in the last earnings reports, signaling that they know the defaults are coming. But for many banks, it's too little, too late. They can't survive the coming wave of defaults. We're witnessing a slow-motion train wreck, but the crash is inevitable. The commercial real estate apocalypse is not a prediction, it's a mathematical certainty. The contracts are in place, and the bills are due. When the crash comes, it won't be a gradual slide. It will be a violent, exponential collapse. It will start with a few defaults, then spread to more banks, triggering panic. The commercial real estate crisis is the catalyst, but it will ripple through every corner of the economy. If banks fail, the FDIC will be overwhelmed, and the government will have no choice but to bail them out, again. But this time, there's no political appetite for such a bailout. This is why you need to understand the bail-in laws that were passed under Dodd-Frank. These laws allow failing banks to convert your deposits into equity to recapitalize themselves. If your bank fails, you could end up owning shares in a bankrupt institution. If you have more than $250,000 in one bank, you're an unsecured creditor. In a collapse, you're the last one to get paid. We're also seeing problems in the insurance industry. Life insurers hold massive amounts of commercial real estate debt to back their annuity payouts. If these debts go bad, insurers won't have the money to pay retirees. The entire system is built on the assumption that real estate will always rise in value. That assumption is being proven wrong, and the system is beginning to crack. At the center of this crisis is the derivatives market. Banks use derivatives like interest rate swaps to hedge against exposure, but the scale of these contracts is enormous, much larger than in previous crises. A small failure could trigger a cascade of defaults, affecting global banks. The $1.5 trillion in commercial real estate debt is the spark that could ignite this powder keg. The Federal Reserve is stuck. They can't raise interest rates without triggering a deflationary collapse, but they can't lower them without fueling inflation. They are trying to navigate a financial minefield, but their options are limited. Meanwhile, the market is beginning to figure it out. Regional banks are already feeling the pressure, and commercial real estate values are plummeting. This situation is not just about empty office buildings. It's about the entire economic system that relies on debt and credit. When that system breaks down, everyone suffers. We're entering a phase where only the most prepared will survive. Those with cash will be able to buy assets at rock-bottom prices, while those who are over-leveraged will face ruin. The wealthy and institutional investors are already positioning themselves for this, waiting for the fire sale to begin. This is your opportunity to prepare. Start by getting your finances in order. Make sure you have cash on hand and limit your exposure to risky assets. The crash is coming, but with the right strategy, you can come out ahead. Be patient, be strategic, and understand the risks. This is not a time to be passive. The collapse is already underway, and the next phase is imminent. Stay informed and stay ready.